A syndication is where so for myself as a syndicator, you are the one who goes out there and gets the larger projects. So usually it's for larger assets like apartment complexes. So you'll go out there, you will find the property, get it under contract, find the loan, and negotiate everything. And what happens is you get investors along that are called limited partners, and they provide much of the capital for the down payment and or the improvements and whatnot. So you're all partnered together. A limited partner is what we call the investor, and the general partner is the people that run the deal. So usually for these, you'll split it. It depends. Like Andrew said, it's always deal dependent, but it's usually like a 70-30 split. So 70% for investors, 30% for the general partners, or an 80-20. So 80% for the investors and 20% for the partners. And
welcome to another episode of the Logger and Listing Podcast. I'm your host, Kurt Warner. This week, I have the pleasure of having two guests on. So we have Andrew Jarrett and Nic Cooper. Welcome, guys, to Logger and Listings.
Hey, thanks for having us.
Thanks, Kurt. Great to be here.
So it was interesting. I was actually on your podcast not too long ago, and based on the conversation that we had and getting to know you guys, I thought it'd be an awesome idea to have you on Logger and Listings this week. So what I found intriguing was how you guys actually met and started investing. So can you guys share with my audience how you guys met and how you guys got started working together?
Sure. Do you want to take it, Nick? Or?
Our love story, you mean?
Yes, your love story.
Yeah, so Andrew and I connected pretty much just online, through a networking group. And then we started to just kind of connect that way. And what really happened is that I went out to Florida for a conference that he couldn't make it out to. And then I drove out from Orlando to Tampa. They met in person and realized hey, man, we really hit it off, not just on, virtually, but in real life, in the flesh. So that was about a year, almost a year ago to the day we were out there, Andrew. So we connected.
Yeah. Pretty incredible journey.
So was it like an online networking community that you guys met in, like a Facebook group, or where was that online platform?
Good.
Yeah, it was online. Yeah, and just a networking group, and just started talking to each other on there. So it was pretty cool.
So did you guys have kind of a background as real estate investors prior to?
Mm-hmm. Yeah, we were.
Andrew, what were you doing in real estate prior to?
So I was in multifamily when I met Nick, and I'd been buying real estate since 2009. Full-time investor. Never had a career. Always invested in real estate, and had just lived off my income from real estate investments my entire life, essentially.
So what was it that kind of drew you to real estate in 2009? Obviously, that was kind of a challenging time with what was happening in the U.S. economy.
Yep.
So what was it that said, hey, real estate is what I want to do instead of looking for an actual job?
Yeah, well, I had a job at a grocery store. I was younger, and I started when I was 15, and I'm like, well, I don't like working for somebody else, having somebody tell me what to do. So I got to figure it out. So I actually read two books. Of course, the purple book, Rich Dad, Poor Dad.
Yeah.
But the first one I read was The Hurdles and Pitfalls of Real Estate Investing by Russ
Whitney.
Yeah.
So interesting segue here. The company I worked for up here initially was Whitney Education Group.
Really?
Back starting in 2004. And then it's transitioned to actually Rich Dad Education in 2007, 2008. So had a chance to meet Russ several times, and very interesting guy and a great story. So you're the first guest to actually mention that book.
Really?
It's awesome.
Well, yeah, it was a great book. I mean, I read that before Rich Dad, Poor Dad, and that's literally what got me interested in real estate, was that book. And he was from Schenectady, I believe, New York.
Yes.
And I was from, Buffalo area. So it's, very similar. I was really
Awesome.
resonated with that book. Mm-hmm.
Excellent. And what about you, Nick? What were you doing before you guys met?
So before I met, I am a retired Navy helicopter pilot. So I did that for 22 years. And during that time, like most folks in the military, you buy, at least in the US, you buy a house and then you get stationed somewhere else. So by default, you become a landlord. So I moved around, acquired some properties, managed it myself. And I looked one day and I was, did the math real quick on my equity. I'm like, I'm making like $100 an hour or $100 actually a month on this property, excuse me. And I'm like, this is not a business. This is like a hobby. So I quickly sold that property, did 1031 exchange, which is, unless you in the US delay taxes on it. And I bought a 24 unit in Ohio. And then from there, I just decided, like, how do I get bigger? And the best way to get bigger is to go with someone else. So you need to partner up in this business. So,
Yeah.
and that's why Andrew and I are working together.
So you guys just focus on multifamily now, or are you guys implementing any other strategies?
Just multifamily.
That's it.
In what markets? Because you guys are not in the same state, obviously.
Correct.
So Nick,
Almost total opposites, I guess.
yeah. So Nick, if I remember correctly, you're in California,
I'm in San Diego.
San Diego, California.
Exactly.
And then Andrew, you're in Florida. So what markets do you guys invest in? Because I know California is a really high priced market, probably difficult to find some cash flowing multifamily there. So where do you guys invest?
We invest, our typical deal we look for is in Florida.
Okay.
So Tampa, Orlando, Jacksonville, and then that I-4 corridor between Tampa and Orlando, like Winter Haven, Lakeland, Haines City, areas like that.
So what are the criteria you look for multifamily right now, especially in this kind of higher interest rate environment compared to when you guys met a year ago?
Yeah, you got to get creative now. I think that's the biggest thing that happens is with interest rates up, there's a way. The bank ones using a traditional bank isn't going to help, isn't really cash flow. So what's going to be is either a seller carryback, the seller is actually the bank, or just figuring out kind of what terms are creative. It's just, you got to get creative now.
So
Which is my favorite way to buy, because that's how I started with all seller financing, getting creative, and it's starting to come back, and I love it.
So are you finding now that sellers are more willing to do carryback mortgages, maybe compared to a year or 2, 3 years ago?
Mm-hmm.
Yeah, 100%. I think that with the seller, I've always been taught that you can either get one thing, it's price or terms. A lot of times the seller is set like, I want $3 million, but then they go, yeah, you want $3 million, but I'm going to have this term for the loan. So I'm going to have like, a 5-year interest only loan at a lower rate that I get from a bank.
Yep. Exactly.
So do you find it difficult to find sellers in general that understand the benefits of it? And, how do you explain it to a seller to say, hey, I know you want, let's say, $3 million for your property, but here are the advantages if you're going to do a carryback mortgage to benefit, get you close to your price. Like, how do you explain that to maybe a more unsophisticated seller?
Well, usually in multifamily, the sellers are a little more sophisticated than, say, like a single family. They kind of understand that side of it, but some don't. So we just kind of tell them, look, if you want your price, we can get you your price, but you have to hold some of the financing, which will actually help you, with your tax, your tax consequences. And also, you're probably used to getting cash flow on this property. So rather than just sell it to us all cash, you can still get cash up front and continue to get some cash flow, over the next 5, 10 years, whatever, we structure with them. So once we kind of lay out the benefits, most people really do want to do that.
I think a lot of the older generation is used to that cash flow. So great, you got a couple $1 million, but where do you put it now? They want that income to live off of. So that's the biggest issue is like, cool, I'll sell it to you, but where do I put it? And that's kind of solves that problem there is like, you're going to become the bank and you're going to get steady income from this property.
So what kind of, rates and terms are you looking at on the carryback right now with the people that you're negotiating with?
Well, like Nick said, if we gave them all cash, they'd put it in the bank and get 0.01% or something, ridiculous. So it really depends on the deal. We've offered anywhere from 4% to 8.5. So it really is just seller dependent.
Yeah, one of the things that we're seeing in Canada is that sellers, when we do the carryback mortgages, we call them VTBs, vendor take back, same thing. But they're actually looking for higher now than they were a year ago, just because, at least in Canada, you can make 4 or 5% just parking your money in the right type of account. So it has become a little bit more challenging than I would say even 6 months ago, just because we're going to have to pay a little bit more. But a lot of times it still works out to the benefit of both the seller and us as buyers. So that is something I think is really common between both investing in Canada and also the US. Now, one thing, Nick, that you mentioned that we don't have in Canada, which I've always been jealous of, is a 1031 exchange.
Yeah.
So for our Canadian listeners, can you share a little bit more about what that means to you guys as investors?
So I've done a 1031, and so what it does is, so when you sell a property, especially an investment property, you gotta pay taxes on it. So what this does is, say if I sell a property for like say $1 million, I go find a property equal or more value and put it into that. I avoid the taxes. I mean, technically you delay the taxes to later, but in a way, no, not in a way, you actually just, you don't pay taxes at all on that transaction. So say you made 800K on that transaction, that $800,000 goes into that property.
So do you have to buy a property that is kind of similar price point or higher, or could it be something that's, so it has to be something similar?
You can buy a property that's less value, but you will pay taxes on that. You'll pay a tax called the boot. So there'll be an extra tax on there of whatever that is. And it's, again, not a CPA or financial advice, but
yes, we'll put the disclaimer in.
yeah.
So let's say that you did sell a property and you had 800,000. Could you divvy that up in like 2 or 3 properties, or does it have to be like one investment?
You can. It does get a little bit confusing at that point. Like you have to start paying some legal fees right there, but you can, as long as they're of more value.
Okay. And so what is your overall game plan at this point? Are you guys looking to acquire multifamily to hold for, 10, 20 years? Or do you have a strategy of kind of improving the value of property and then either trying to refinance to pull some out or even sell?
I think that go ahead, Andrew.
I was going to say, we'll do both. We definitely want to hold properties for long-term wealth, but we also will syndicate with our investors and give them a good return as well. So it really depends on the deal. But long-term, Nick and I are both in this for the long haul, and we want to hold property, for a long time.
And most investors are going to want their capital back eventually. So the kind of timeline we give them is 5 to 7 years to hold it up, because this is not a liquid asset. You can't just be like, hey, I'm having a hard time, I need to get my investment back. Like, now it's stuck in there. Like, until we sell, that's where it's going to be at. But what, to kind of expand upon what Andrew said, is you have kind of like a legacy, properties where like, hey, you hold them and long term. Like, I have one of those. My first one I bought, it was just myself and a partner. I'm keeping that for long term. But with syndication, usually it's always going to be a 5 to 7 year timeline.
So for people that are kind of newer to real estate or listening to this, what is a syndication?
A syndication is where so for myself as a syndicator, you are the one who goes out there and gets the larger projects. So usually it's for larger assets like apartment complexes. So you'll go out there, you will find the property, get it under contract, find the loan, and negotiate everything. And what happens is you get investors along that are called limited partners, and they provide much of the capital for the down payment and or the improvements and whatnot. So you're all partnered together. The limited partner is what we call the investor, and the general partner is the people that run the deal. So usually for these, you'll split it. It depends. Like Andrew said, it's always deal dependent, but it's usually like a 70-30 split. So 70% for investors, 30% for the general partners, or an 80-20. So 80% for the investors and 20% for the partners. And kind of how the sale is that they are given a preferred return. That's not a guaranteed return, but that's what, for any of these gets paid out. So I give you an 8% preferred return. That gets paid out for anything else. So that's your pretty much that's your number one on the list for getting money.
So when you're doing the preferred return, because I've heard this structured different ways by different investors, and we also structure it differently ourselves depending on the deal. Whether it's like a monthly, quarterly, annual, and sometimes it's even deferred until, the end, whether you're refinancing or the plan is to actually liquidate the property. So what structure do you guys typically work with through your syndications?
Quarterly payment is how we do it as far as payment out for the preferred return. And then before, if you on sale, any preferred return that's not paid out gets paid first.
Yep. Yeah, that's a great way to protect investors, to give them some assurance that, you as the general partner aren't going to, sell the property and like take all the profits and like, well, there really wasn't a lot left. So here, it keeps that relationship going where, you, in that 5 to 7 years, they get paid out, they got the preferred return, whatever the split on, sale was or disposition was, they also get that, and they can then look at you and say, hey, it was great working with Andrew and Nick. These are some good guys, good investors. Let's do it again. So creating that repeat business, I think, is awesome.
That's a good point. I think also making it easy to understand. Like there's a thing called waterfalls where if I hit a certain return metric, then it's more for the general partners. And I think that gets confusing.
Mhm.
And a confused mind says no. So it's like, hey, it's a straight 80-20 split. That's it. Not like it's if you win, we all win.
Absolutely.
Yeah, we look for long-term relations with our investors too. So we want to make them happy, make them make money, and we also want to make money at the same time. And with syndications, everything is, SEC compliant, Securities and Exchange Commission. JV, we don't deal with the SEC in that, but yeah, I mean, as long as everyone's happy and making money, that's the goal.
So when you're working on syndications, again, there are people that want to get into real estate, but a lot of time what holds them back or what keeps them looking at smaller deals like duplexes, triplexes, because they don't feel they have the capital or can find the capital. When you're putting these syndications together, are you guys also investing your own capital, or are you relying mostly or solely on, the limited partners?
We'll invest our own capital as well. Typically, the general partners, like our group, will have 10% of our own capital in the deal and then raise the rest. But yeah, we do invest in our own deals.
And it will put up all the costs in the beginning. So you have to have inspections, legal issues, and those are things that are, $10,000-$20,000. And if it doesn't go through, the general partner takes that hit.
Yeah.
So say the deal doesn't close for some reason, you get all your money back. The general partner is the one who takes that risk.
Okay, so you're really eliminating all the financial risk from the investor standpoint where, it's only once conditions are waived and the property is closed where the funds are actually then transferred to actually close on the property and then move forward from there. Right. So let me ask you guys a question. I like to ask this to investors that have done several deals, especially when you go back to the dawn of time when you started back in 2009. But what is the most challenging deal that you guys have been a part of, either as individuals or as partners?
Go ahead, Andrew.
Well, for mine, it wasn't multifamily. It was a single family flip, and it was a nightmare. And that's why I don't do single family flips anymore. You never know what's behind the walls. You have to deal with all kinds of, local ordinances. The market is based on, comparables. You have no control over the income or the expenses. It's all, appraisal versus multifamily is NOI and your expenses, right? So you can raise the NOI and the cap rate is good. You'll increase your value. So yeah, my worst deal was here in Florida, and it was a single family flip that did not go well. And I think it took like 12 or 14 months to sell.
Oh, wow.
That was the last one I did.
Do you remember what year that was in?
That was back, it was probably 2015, maybe. It was a very tertiary market, so we were kind of pushing the envelope on it.
Okay, so was like your business at that point focused on flipping, or was it just like, hey, found this property, let's flip it and make money?
Yeah, so I was wholesaling in Florida there, also doing fix and flip and buying multifamily. So I was doing, all three at that time.
Okay.
So that one just seemed to be a good deal with a lot of spread. So we took it down and tried to retail it.
So have you flipped the property since then?
Not single family.
I hear you. It's funny that as investors, like you have one deal or one strategy that goes bad and it can shy you away from dipping your toe back in there. I was the same way with a pre-foreclosure back in 2007. Have not touched one since, although I know it's a good acquisition strategy, but then again, single family home as well. So single family home, pre-foreclosure, I'm not touching it.
Yep.
So Nick, what about you?
So for me, I'd have to say that it was a single family, just like Andrew said as well, is that it came out to being a bad partnership. And then I think a lot of these folks here think that the market always goes up. Well, this is back in 2005 to 2008. And the market, I'm in San Diego, and it took a turn. And what happened is my partner had a disagreement on this property, and he wanted to sell. I didn't want to sell, so a bunch of lawyers later, we ended up selling. We didn't owe the bank any money, but it definitely was a hit for us. And I think that it's that old saying is that money doesn't change you; it just reveals who you are.
Mhm.
So I think the mistake that I could make from this or share with you is that, hey, a handshake really matters, but if stuff goes bad or really well, the person you partner with is going to show you who they are. So make sure you have those legal agreements in place and you make it a professional, structured, it's a business. Look at it that way. It was just a handshake. So make it into a business because things may go bad.
Yeah, what was it? Because you mentioned, in the beginning that you guys kind of connected online, and then when you met face to face, you're like, okay, this partnership works. What were the attributes that you guys saw in each other that made you say, okay, this is something that we can do together and build something from?
Well, I think I'll go off first for Andrew. Like, you can tell you're a professional. And I think that in the past, I've dealt with amateurs. These amateurs have cost me money. And so this guy's been doing this his whole life. He had a job, I think, for 6 or 8 months, and the rest of it's been doing real estate.
Mhm.
So someone that's actually done it and doing this for a living, not just, hey, no shade if you're also a W-2 employee. I was too when I started, but this guy didn't even have, didn't have a W-2, and he was doing this all on his own. So that's what really drew me to him. And he's honest, straightforward. My wife met him,
Mhm.
and she's usually the best judge of character. Wife and my dog, if they say you're all right, you're all right. But no, seriously though, it's someone who's been doing it. Not just, hey, I want to learn. It's like, hey, I'm doing really well now. You're doing really well. How do we link up and make this happen?
Yeah, awesome. Andrew, for you, I feel like this is like a dating show or something. What was it that really drew you in?
Oh, dreamy.
I would say Nick and I share the same values, very trustworthy. I would never have a problem, with money or anything with Nick. And we're both, very motivated, and we hold each other accountable, which is huge, really push each other. If one of us having a bad day or something doesn't go right, we're like, hey, man, we'll get the next one, So it's really just the same values, and that really comes through with each other. So
It's crazy what you'll do for someone else. Like, if someone's counting on you to do something, hey, there's all these little crappy tasks you don't want to do in your business. Get that LLC set up or filing that paperwork. If your partner's like, where the F is this? You're like, oh man, can't let him down,
right,
And
exactly.
give yourself excuses, but you can't give someone else excuses. So the accountability piece is huge.
Yeah, I really like that because again, it's so much easier to go it alone. Like you don't have that resistance, but you go so much further when you start working with the right people, the right partners. But, as you mentioned, Nick, a lot of people end up picking the wrong partners. Sometimes it's because, hey, it's a, cousin that, it's family, and, like there's really no synergy there. You're not on the same page. You're not moving in the same direction. So it's awesome that you guys were able to meet and collaborate and, really start putting something together as a business moving forward. And also, from what you're saying, looking at this as a long-term plan, not just, hey, let's do a couple deals together and then move our separate ways. It's really building towards the future.
Mhm.
So one of the things that I know I hear a lot from new investors, especially, or people that are maybe, 1-2 years in, they get to a point where they're stuck, where they're not able to acquire as many properties as they want. So for you guys, what does that look like, especially being full-time investors? Like how many offers, how many properties are you guys looking at on like a monthly, weekly basis?
A lot.
Yeah.
Yeah, we're looking at a lot of deals. They say it was always 110-1, right? 100 deals, 10 offers, one's accepted. I would say it's more than double that now.
Yeah, it's 150, 200 now that we're looking. And by looking, you don't really deep dive on all 200 of them. But those are usually like a 10-minute look or even a 5-minute or a 1-minute look. You
Yeah.
know?
Yeah. At the
Yeah,
same
and
time
that's
you're looking at deals, you have to be, kind of massaging investors and bringing new people into your pipeline as well, because you're going to need those LPs or the private money, for smaller deals too.
So do you guys split up the responsibilities? Like, do one of you kind of look more after finding investors and limited partners, and somebody else focuses more on finding deals?
Mm-hmm. Yep.
So who does
Yeah.
what?
You want?
Andrew's more the deal finder here, I'd say, and I'm more the analysis side of it in the operations. So once there's one person, we all can talk to brokers and find deals, but for him, he's the one who collates it, says, hey, this is priority, go after this one first. Because if you have 100 different deals to look at, which one's a priority?
Yeah.
So that's the most important. Not all of them are a priority. And some like, hey, this is the hot one, get this one today.
So are most of the deals that you're finding like on market, off market? Are you working with, realtors or wholesalers?
Yeah. So for the larger deals, 75 units and up, it's all brokers, no off market stuff there. And those brokers really, there's a team of us looking for deals and buying these. So they really want one person in that group to contact. So that's why, for the larger stuff, it's only me talking to the brokers, because they want to know, who to call if they have questions. For the smaller deals, I would say 50 and below, we are going off market, finding direct to seller, and also dealing with, residential brokers at that point. And we have, Nick and I, and then one other person is actually calling brokers as well in that smaller deal space.
Okay, so you actually have somebody else on your team. Are they also a principal in your business, or are they more of somebody that you hired to actually do that kind of job or take that role on?
They're a principal, one of our partners. Mm-hmm.
Okay, awesome. It's interesting. I've always believed that when you have a partnership, if you can have an odd number, you don't get stuck with trying to make a decision. Usually it's you have choice A, choice B, two people pick one, and you have to respect, the partners and people that you're with, and then go with that decision. So it does make it easier to actually make that final call when you have 3 or 5 people as opposed to, 2 or 4, which I think is
That's a good point.
Mm-hmm.
So what are your plans? Like, if you look at your business, let's say 5, 10 years out, like, do you guys have a goal of how many, units you want, how many deals you want to have done? Like, what do you guys see for your business?
I'd say for us to be 1,000 units is what we want to be at as far as like under management. That means us as the primary, operators of it, because it's not just raising the money and getting the investors together. It's like, hey, you have to operate now. That's when the real money is made, is when you get closing table, paperwork signed, ink's dry, then you have to implement the business plan. So to operate that amount of units, not just to transact it.
Yeah.
Okay. And I assume you guys work with like property managers and local teams and markets. So do you find like the deals first? Like, what comes first? Is it finding the properties you want to invest in, then trying to build a team around that market? Or is it more, okay, hey, here's a great market, let's put a team in place, and that way when we find a property, we close and the team's already in place, they know our strategy, they know what we want to achieve?
Yeah, definitely focus on the...
Go ahead, Andrew.
I would say, yeah, definitely focus on the market first. You want to pick a market, population increasing. We like Florida, no state income tax. You have nice weather, a lot of people moving there. So that's, it's a big plus for us. But you definitely want to build up that team, because if you find a deal, say you're going to move and put it under contract, if you don't have a property manager lined up to give you a budget and go look at it, maybe they're going to see something you don't see, you could be in trouble. So, because you're going to be taking that over and managing that real soon. So we have, several property management companies we work with. They go look at the deals for us and with us, when we're looking to put in an offer. And so I would get those in place, have a good CPA, a good attorney, possibly SEC attorney if you're going to syndicate, and have that all lined up ahead of time.
So do you guys actually physically go and look at properties now? now that once you have established the team? Like, Nick, are you flying over to see property?
Once we have something that's going to go under contract, I will. But for Andrew, he tours, dozens, and that he does the primary tours. But then once we have something under contract for the inspection, I'll come out for that.
Okay. Yeah, that's interesting because, some investors are like, I don't need to see it. Okay, if they're like me, I'll throw myself in this category. Once having a team, I'm not as concerned about going and seeing it, as long as, again, that team is in place. Also, because if I went and saw, a property and did the walkthrough, I'd be like, yep, it's a building. That's the level of expertise I have when it comes to that. So I think it's important. So what would you say is your superpower as investors? Nick, you first. What's your superpower as an
I'd
investor?
say for us, it's the integrity piece, and it's like when you invest with us, you know what you're getting. You will not be confused. Like I will not invest in it. I don't know what I'm doing. I look at it this way. Like I was a pilot in aviation. Like we're all on the same plane. So I'm just the one driving and I'm the one flying it there. We all want to land.
Mhm.
So I think for superpower is like, I think you got to have integrity, and it's not really superpower. It's just a character trait, and just be transparent.
Andrew, anything to add to that?
No, I think that's a great point. And, Nick and I both agree, like our investors come first. If a deal goes bad, we will do whatever we have to do to make sure our investors are whole, no matter what the detriment is to us. So I think that's, something.
You have to do what others won't do. So for me, when you buy a property, especially multifamily, that we call value add, that you have to do a lot of work in the beginning, is that I even had a property where I flew down there and stayed there for a week at the property in a vacant unit, like away from my family and wife. And like, you see a lot of things that go on there, and most people won't do that, So.
Awesome. So I'm going to ask you guys a final question, and I want you each to answer individually. So obviously we're pretty, fresh into 2023, and obviously wrapped up 2022. If there was one word, and we'll start with you, Nick, that you could use to describe 2022 for you, what would that one word be?
So last year.
Last year, yeah.
Potential.
Okay, awesome. Andrew, same question to you.
For 2022, I would say a setup for 2023, because 2023 is going to be amazing.
Okay, awesome. So final question, where can people get a hold of you? So if there are people that are interested in investing with you guys or listening to your podcast, how can they get a hold of you guys?
Yeah, so you can go to YouTube and just type in Passive Road to Retirement, and that'll get you to our podcast. And you can go to www.jarrettcapital, JARRETT. You can also watch the podcast there and contact us there, schedule a 15-minute call, or, send us an email.
Okay, awesome. So I'll make sure to put some links in the description below so people can get a hold of you. Again, I highly recommend anybody listening to this podcast, listen to their podcast as well. A lot of great insight, a lot of great guests, including myself. Shameless plug.
Shameless plug.
It was a good episode. People should watch that one.
That was a lot of fun. It was a lot of fun. But yeah, definitely get in touch with them. And if you are looking to invest passively as a limited partner in deals in Florida, and hopefully I can come down and maybe meet you guys up there.
Yeah.
Today would be good. Cool. That'd be awesome. But yeah, definitely reach out.
All right. Thanks, Kurt. Appreciate it.
All right. Thanks, guys. And to all the listeners, thank you for listening to another episode of The Logger and Listing. Until the next time, cheers. Thank you for tuning in to another episode of the Logger and Listings podcast. I hope you enjoyed listening as much as I enjoyed bringing it to you. If you liked what you heard, don't forget to leave a like, comment, or even better yet, share it with other aspiring investors and entrepreneurs. Your support helps this podcast grow organically, and in turn helps other investors and entrepreneurs grow their businesses and have fun along the way. Thanks for listening, and I'll see you on the next episode.